Hi there. Welcome to The Close. I'm Lindsay Biscaya. Markets will be closing in half an hour from now. But first, let's get to some of the stories we're following in the BNN Bloomberg newsroom. The federal government is looking to strengthen Canada's steel industry by cutting interprovincial transport costs. It announced a $100 million rebate program of eligible steel products moved by rail and marine between provinces and territories. Ottawa says it will rebate half of eligible transportation costs for up to 1 year or until funds are exhausted. And shares of Barrick Mining are under pressure today after missing second quarter profit estimates. The Canadian miner is also facing rising production costs and tax penalties in Mali. Meanwhile, Barrick says it has reached an agreement with Newmont on their Nevada joint venture worth nearly $2 billion. And it's also pushing ahead with an IPO by the end of the year. An Ontario teacher's pension plan saw some gains in the first half of the year. The pension manager earned 9.5%, and that boost was driven mainly by a stake in SpaceX, worth $8.7 billion. The fund says investments in venture growth, public equities, and inflation-sensitive assets also boosted returns. And we're keeping an eye on the TSX before the closing bell. It is up, not by a huge margin, but still above 36,000 points. The energy index really driving the TSX up today, with oil prices also rising. But it's interesting to see how it's having almost the reverse effect on U.S. markets. If we take a look there, we've seen, as I mentioned, that rally in oil prices has left stocks wavering today. All three of the main markets in the red, with trader anxiety building just days ahead of key inflation reports as well. So keeping an eye on that for you. Meanwhile, Canadian gold miner Barrick is slumping after its second quarter earnings miss. For more on that and other market action, joining me now is Graham Crindler, Associate Portfolio Manager at New Gen Asset Management. Great to have you join us. Thanks so much.
Thanks for having me.
So what is driving down Barrick today, and why is it lagging its peers in the sector, do you think? We'll get to the deal in a moment, but just in terms of the earnings report from Barrick.
Yeah, as you mentioned, Lindsay, they reported their earnings this morning, and their earnings itself, we could nitpick some of the metrics there. I think the production numbers overall look okay. The free cash flow is a little bit lighter because of some working capital metrics. But driving a stock today is really the dynamics of that deal that you mentioned earlier, and I'm happy to discuss that in a bit more detail.
For sure, and obviously, okay. So let's get your thoughts on that deal as well.
Yeah, so Barrick is underperforming its larger peers in gold mining for quite some time, and one of the initiatives that they've taken to try and close that gap is trying to IPO their North American assets to help to split out the jurisdictional risk between what they have in North America and what they have in the rest of the world, in jurisdictions like Africa. To do that, they had to get the blessing of Newmont in terms of this joint venture, their stake in the joint venture that they were going to IPO and called Nevada Gold Mines. And Barrick's one of their crown jewel growth assets called 4 Mile was going to be, there was a lot of speculation, was it going to be included in that? Was it not going to be included in that? Ultimately, this morning, Newmont gives Barrick its blessing to go ahead with its IPO, but in return, 4 Mile gets vended into this IPO. Now, what the big disconnect here is the fact that the value of that 4 Mile is getting vended into came in at about half of the street expectations. So that's what you're seeing drive the weakness in the stock this morning.
Yeah, and with so much potential there for 4 Mile, it'll definitely be interesting to follow. I want to go back to oil prices just more generally now, kind of going off of Barrick. Obviously, we're seeing oil prices rallying today amid continued tensions in the Middle East. How do you think investors should be approaching the energy sector in this environment when we see the volatility still continuing?
So it's been a very, very active commodity complex across the board this year. The story with energy is definitely being driven by geopolitics, geopolitical tensions. We saw oil drop to around $70 a barrel when there was initial headlines of a ceasefire between the U.S. and Iran. And then we saw it recently spike up to as much as $90 a barrel, which is shy of the highs of the year overall. But we're definitely seeing these swings back and forth depending on where the news cycle is headed and where talks are perceived to be headed with respect to a ceasefire or not. So I think the idea is that the geopolitical risk and premium in energy is still very healthy. And anyone trading in the sector should expect continued moves as things unfold in real time.
Okay, another piece of news we're following today, obviously, is Ottawa announcing that $100 million rebate plan for domestic steelmakers shipping their product across Canadian provinces. Do you see this impacting any related stocks?
Yeah, we're no stranger to tariffs in terms of its impact on the Canadian market. One stock that comes to mind is Algoma Steel, which is a Canadian producer of steel, and it's been heavily impacted by these tariffs. This is a nice announcement to see this morning. Interprovincial trade has been something that's been highlighted as a way to help offset some of the blow of these tariffs. But I think as we look to next week and there's negotiations between US and Canada on $20 billion of tariffs, 20 billion with a B, and we see a $100 million program from Ottawa, it's a nice to have, but I think there's much larger things at stake here that'll be much more impactful for companies like Algoma and anyone else continuing to muddle through this tariff situation.
Okay, let's talk a little bit more about that, though, because we're nearing that August 19th deadline for tariffs. I wonder how you see trade tensions affecting Canadian earnings this year, as well as Canadian stocks as well.
It's really we would love to have an inside track and know what's going on with these tariff negotiations and talks. I think if we were to rewind to the beginning of all the tariff tantrums, I think we were probably expecting to have made a bit more progress by this point in time. Mm-hmm. But things continue to unfold, and some concessions here, some saber rattling there. It's really a cloud of uncertainty over the Canadian economy, over certain companies. But I think the bottom line is that people continue to manage, companies continue to manage the best they can. I think they're working within an envelope of uncertainty and going on with business as usual. Now, the big risk is that you could wake up one morning and have a new headline that completely changes the tariff regime, or there could be new tariffs. We could see removals of others. So I think generally the idea is we're working towards probably more narrow resolutions on certain topics over time, whereas maybe 6-8 months ago we thought we were going to get one broader sweeping solution. So I think we continue to live on a issue by issue basis, and we're looking for measured points of progress over time to try and see what the pathway forward looks like.
Okay, we're almost out of time. You do have a couple of stock picks. We might not be able to get to all of them, but I do want to try to get to some. The first one, Group Dynamite, it's seen a 22% drop this year. What are some of the catalysts that you think could maybe turn this company around?
Yeah, this is a stock we've mentioned on before, and after its last quarterly earnings, the stock dropped 40%, which we thought didn't make any sense. Now, the stock's regained about 35% of that move, but still has about 20% to go to reach its pre-earnings highs. The business is intact. It's continuing to grow. It has some of the best financial metrics and margins among its peers, and it's trading just in and around its valuation from when it IPO'd a couple of years ago, when its peers trade probably around 10 points higher than where it's currently trading. So I think the catalyst there is continuing to demonstrate to the market and to investors that there's plenty of growth ahead, and the business model continues to churn out best-in-class numbers.
You also like Canadian bus maker NFI Group. It's already up over 50% this year, so maybe a lot to like, but tell us more about your kind of investment case here.
Yeah, so you see a stock up 50% and you think, well, maybe all the good news has happened already. They just reported their quarter where they increased their guidance. They're coming off of a number of years exiting the pandemic with a number of supply chain issues. Their cost structure was upset. Their balance sheet was in a difficult position. We continue to think that NFI is in the turnaround stage. We think many of these issues are behind them. The company has a new CEO in place and putting a quarter, as I mentioned, with higher guidance. The stock's valuation is trading in and around its average, and we think there's more growth ahead. And if sort of a no news is good news situation for NFI moving forward. And ultimately, at the end of the day, we think there's continued demand for mass transit across cities in North America and the rest of the world. And NFI happens to be an industry leader in the development of that. So we like where the prospects going forward in terms of continuing on that path of right sizing and growing the business. If
you can just give us maybe in 30 seconds your investment case for AGF Management, that's your last stock pick. Why do you like this one?
Yeah, very quickly, your previous guest was talking about tremendous earnings growth in the market, and in bull markets, asset managers tend to do very, very well. AGF is an independent asset manager, which are harder to come by these days, given industry consolidation. and its valuation is deeply discounted relative to its peers. And we think as long as the market continues to hold up here, this is a great place for investors to find some torque on that.
Okay, Graham Kreindler, Associate Portfolio Manager at NewGen Asset Management. Always appreciate you joining us. Thank you.
Thank you very much.
Up next, we are watching oil prices rise today as markets grow increasingly skeptical that a deal can be reached to reopen the Strait of Hormuz. We're back in a moment with more on that. Oil prices rose today as doubts grew that the U.S. and Iran will reach a deal to increase shipping traffic through the Strait of Hormuz. Meanwhile, crude oil stocks in the U.S. Strategic Petroleum Reserve have fallen below 300 million barrels. That's the lowest level in more than 4 decades. Let's get more now from Matt Gerken, head of Geomacro at BCA Research. Great to have you join us. Thanks for taking the time.
Yeah, thank you very much, Christine.
So when you look at the demands Iran says that the U.S. must meet before the Strait can actually be reopened, do you feel that Iran actually has the leverage to be making these kinds of demands with the U.S. at this point?
Yes, I think they have a lot of leverage because of their geographic proximity and asymmetric military capability around Hormuz that they've demonstrated. So what they can do is agree to a ceasefire to tie President Trump's hands, and then they can continue to fail to implement that ceasefire effectively, thus keeping the oil price elevated and sapping the American people of the will to continue the fight beyond in the coming months and years.
And then I wonder, like on the flip side, do you think that Trump would actually be willing to consider some of Iran's conditions, at least in the interim, if it meant bringing oil prices down, particularly with midterms nearing?
Yeah, exactly. In the lead up to the midterms, the president has several races in the Senate for the Republicans that are on a knife's edge and are still competitive. And Democrats have stumbled a little bit, like in the case of Maine. They have a very competitive race in Michigan. So there's some races that Republicans could still win and then hold on to the Senate. And that would give the president a little bit more breathing room in the last 2 years of his term. And that means that he must get the oil price down. He must bring some relief to households as much as he can. In the end, I don't think it will save him, but it's simply going to govern the way that he manages foreign policy for now. And then after the midterm, he can roll up his sleeves and try to increase the military pressure on Iran one more time.
Okay, so let's talk now about the point that I mentioned right before we brought you in. That's U.S. crude oil stocks in the Strategic Petroleum Reserve falling below 300 million barrels. That's the lowest level in more than 4 decades. How much further do you think can the U.S. draw down the reserve before it really starts to get problematic at this point?
Oh, good question. No, we're at that point. We're at the threshold where we're so far beneath long-term averages that it needs to be replenished. And the SPR has been tapped by multiple presidents for purely political reasons or for foreign policy reasons that tie in with the midterm and other elections. So it's normal that the president has tapped this, particularly given that he's waged a conflict in the Middle East. What was abnormal was that the U.S. did not build back the reserves after drawing them down during the really high inflation days in 2022 and 2023. So there was a lack of foresight and a lack of communication between the Biden and Trump administrations, lack of planning. And now that's coming back to bite the U.S. And it reinforces the point made earlier that President Trump simply has to accept a bunch of messy compromises to placate the Iranians for now until a future time when he's got a little bit more bandwidth politically and on the energy side. And that may not even really come about all that much in his second half of his second term.
How long does it take to build back those reserves? I guess it depends on how low they are in the first place.
Yeah, well, true. No, I think the key thing there is that once you get below about where we are now, about 300 million barrels, you need to really start thinking about the quality of the oil that you're going to have and then the long-term ramifications for the facilities if it's too low. Now, restocking has happened pretty quickly in the past, but it's a price issue. You don't want to be buying and rebuilding at, $100 per barrel if you can get that price down. And so you need to stabilize the Strait of Hormuz in order to get oil flowing again from some of the world's biggest producers, and then get the price down so that you can start rebuilding. So I don't think it's a question of time so much on the rebuilding. It's more a question of time in placating the Iranians and getting Hormuz flowing again.
I see. Okay. And on that note, you've said the Iran conflict could reignite after the midterms. Do you really see Washington being able to actually achieve anything different in a second round of fighting that wasn't achieved the first time around?
So that's a great question, and the answer may be no, that they can't achieve more. They do still, the Trump administration has to continue to focus on the business cycle and the 2028 election. So it's not as if the midterm election is the end of its constraints. Instead, they have a window of opportunity from basically right when the election's over, November 4th of this year, until maybe sometime middle of 2027 or late 27. And that is a period where they can apply some more military pressure on Iran to try to get a feasible deal in Hormuz and over the nuclear program. And once we get toward 2028, those electoral constraints start to really squeeze the administration again. So I think it will be a partial military escalation, but the president is still limited in what he can do. He has to, for his legacy's sake, he has to end with a still strong economy if he can. And he can't do that if he wages total war against Iran.
Okay, we'll leave it there. Matt Gerken, head of CEO Macro at BCA Research. Appreciate you joining us. Thanks so much.
Thank you.
Coming up, Barrick Mining has made a deal with Newmont, but investors worry the value may be too low. We'll have more on that after the break. Stay with us. Barrick Mining has reached a deal with Newmont regarding their Nevada joint venture, and some investors are saying the value of that agreement seems low given the quality of the asset. We got more from John Ing, CEO of Mason Placements Canada.
The biggest gold complex in the world. Barrick has something like 68.5%, and Newmont holds the balance. Now, when they created that agreement, there was likely a clause which said that if there was a change in either the assets control, that there might have been a ROFR. Barrick has said for some time that they could go alone, but I believe that it was a negotiating chip. And the key is 4 Mile. 4 Mile is a Barrick discovery. It is something like 8 million plus ounces. It's a mega mine, potentially a 600, 800,000 ounce a year mine. That's outside the joint venture. So the agreement that Barrick and Newmont came up with, and that's what's expected, was that it was vended into the joint venture now. Mm-hmm. So the joint venture now owns 100% of the mine, or potential mine as it is. Newmont, in turn, has written a check or will write a check for almost $2 billion. And that, I think, was a pretty good deal because there are some numbers going around that the joint venture for its share, the stake could have been as high as $6 billion. Again, I think that was all part of the negotiation. So $2 billion to get a mine that is going to be a mega producer, already widely expected as one of the tier 1 mines, one of the best mines in the world, potentially, that I think that it's a very good deal for both parties.
Okay, so you answered a couple of my questions there, which was that potential that 4 Mile really has, and also whether you feel that this is a good, fair valuation. What's the significance, do you think, then, of Newmont consenting to Barrick's spinoff of its North American assets?
Well, Newmont and Barrick have this joint venture has been since way back when Barrick attempted, Peter Monk was around, to buy Newmont. 4 Mile, as a mine, could make up almost a good percentage of the value of not only the joint venture, but the joint venture itself is a big value of Newmont. So even with a 38.5% interest. So it was important for Newmont to come together with an agreement. Newmont has been as they changed CEOs, they've changed management. They have been up to their eyeballs in problems in the acquisitions that they acquired before. So this was something that they needed to rest and needed to get behind them. So I think that it's a promising agreement.
Many investors, though, are upset, it seems today, about Barrick's spinoff, saying they don't want to dilute their exposure to Barrick's most valuable assets. What are your thoughts on that? I
agree with them. There's no question that I think that the original idea was to spin off the stake in the joint venture, in not only the joint venture, but to create a value out of the IPO, that the sum of the parts, so to speak, argument. But I thought that Barrick, in spinning off, it was a reaction to some dissident and some activist shareholders. I think they misguided, believed that if they spun off a portion of the gave value, you would see the value surface in Barrick. I side with the other major investors that, in fact, it is sort of like it's a crown jewel. You're giving a piece of the crown jewel. So there's it's already been almost preordained that by the end of the year, the IPO will come out. I think that it's sort of financial jiggery, and Bay Street will see through that. The bottom line is it's supposed to create value. Gold's going up anyways. Barrick has the top tier one mines of all the world miners. So I side with them, but it's going to happen.
Okay, we just have 1 minute left here. I did want to get, obviously, the big news of the day was that deal, but Barrick also reported its earnings. So I wanted to get your thoughts on some of the key takeaways from what you saw in the print.
Well, the number of ounces, almost 800,000 ounces, were up above expectations. So that was good news. The bad news is costs, again, seems to be a problem for all the miners. There's fuel costs. Something like a $10 per barrel move in the price of oil translates into like $12 an ounce in cost. So that's what disappointed investors. I can recall when the all-in cost was $1,700. Now it's $1,900 an ounce. Mind you, the gold price is much higher, but costs are a factor.
That was John Ing, CEO of Maison Placement Canada. And let's take one look at the markets before they close in just a couple of minutes, because the TSX reaching a new record high today. It's well above 36,000 points after reaching some record highs yesterday. You can see today it's still in the green. We know energy prices are up today, oil prices, that's driving the TSX up. So interesting stuff. We'll keep an eye on that. Markets are closing in just a moment. Up next, we've got the closing bells on Bay Street and Wall Street. Stay with us. Here are the closing bells at the NASDAQ. Turn Therapeutics is ringing the closing bell today. On the New York Stock Exchange, Western Midstream Partners rings the closing bell. And on the TSX, Hemlo Mining Corporation closes the market. You are watching The Close on BNN Bloomberg. I'm Lindsay Biscaya. Here's how we close the day on Bay and Wall Street. Okay, here's a look at North American markets and where they closed today. The TSX reaching another record high after seeing some record highs last week, well above 36,000 points today once again. And so closing the day in the green, helped very much by oil prices, which have been spiking today. We're going to be talking about that in just a moment. Not the same story, though, for the S&P 500 and the NASDAQ. That seems to have caused the oil prices, that is, and the energy demand causing a bit of jitters when it comes to investors there. Those two big markets ending the day in the red. If we take a look at some of the big movers of the day, though, on the TSX, we'll start with some of the gainers that we saw today. Strathcona Resources finished the day at the top of the TSX, up more than 8%. It's extending gains from Friday's sessions after reporting higher operating income in its second quarter, as well as a jump in oil and natural gas sales. International Petroleum up more than 8% as well to finish the day. It announced the buyback of more than 72,000 shares. So some big news for that company. And then Endeavour Silver is closing $25 million revolving term credit facility with ING Capital. So Endeavour Silver up more than 7%. On the flip side, though, there was some laggers. Of course, there always is for the TSX to finish the day. Superior Plus finishing the day down more than 9%. It's been cut to sector perform at RBC Capital Markets, and RBC also cut its price target there. Barrick Mining, another laggard on the TSX, down more than 6%. It posted profit in its latest quarter that disappointed investors. And Barrick also facing rising production costs and tax penalties in Mali. Of course, we've been following that story today. And ATS Corp, another laggard on the TSX, down almost 7%. It was downgraded to a hold at TD Securities, which is factoring into what you see here. Okay, for more, we are now joined by Bloomberg's equities reporter, Stephanie Hughes, to break down a couple of the big stories. Stephanie, I just mentioned Barrick Mining. You're talking about that, too. It's a big story today. It's falling the most since March after that deal with Newmont seems to be really disappointing investors. Give us a sense of what you saw today with Barrick.
Yeah, that's right, Lindsay. There's a few moving parts about what's a lot of headlines going on around Barrick, a lot to unpack. But what we saw with the share price reaction today was that the stock dropped by nearly 10% at its lowest point today. Like you mentioned, that was the biggest intraday decline since March. And the biggest driver behind this move is that Barrick reached an agreement with Newmont regarding its Nevada Gold Mines joint venture, which also involves going ahead on an IPO for the North American assets. But analysts took a step back and they argued that the valuation for Barrick's assets and the agreement fell short of what they were expecting to see. So we heard from a few analysts, one of them including BMO Capital Markets analyst Matthew Murphy, who added that the second quarter results were a little weaker than he was expecting, and but then also acknowledged that Barrick's guidance was on track, and the focus right now is completely squared on the Nevada Gold Mines assets. And to be fair, there has been kind of a mixed reaction towards the results. Some analysts I've read from said that it wasn't actually as bad as they were expecting. Some kind of framed it as having neutral results. So I guess that's kind of the like mixed results, kind of a mixed bag there. That's what we can kind of take away from the analyst reaction. And speaking of a mixed bag and the moving parts I was mentioning, Barrick also, another development today was that Barrick named Mark Hill as the CEO of its North American company. So Barrick, for its part, over the past 12 months, it's actually been doing pretty well, riding the same wave as other precious metals mining companies, riding that gold rally. So it has a pretty healthy double-digit boost over the course of the year. So today probably marks something of a minor setback, just in the grand scheme of things. And we will have to keep an eye on how it trades throughout the week. Maybe there's some dip buying, who knows? But today it's been to your point, a laggard, Lindsay.
Yeah, for sure. Also, Superior Plus, another company that's come under pressure today after a downgrade. What's the reason for the downgrade here?
For sure, yeah, RBC flagged actually kind of numerous reasons for the downgrade, expecting shares to kind of trade range bound. I can get to that in a second, but the impact was immediate. So we saw the shares fell by over 9% at its lowest point. That was its worst trading day since February, and it was enough to knock the share price down to its lowest level since May. That came after RBC Capital Markets moved the recommendation to a sector perform from a sector outperform rating. That's kind of like moving a stock to a hold from a buy rating. So the reason behind the downgrade, like I mentioned, it was the analyst team expects the stock to trade somewhat range bound over the next 12 months for reasons like weather risks surrounding El Nino. They also flagged a pause in share buyback activity that may extend into 2027, so next year, and then just these elevated capital expenditures that are expected to lead to a more constrained balance sheet. So there's a few kind of issues that they're flagging on the report card there, but they did acknowledge that management is actually making some progress on its Superior Delivers business and is really optimizing that propane segment. So for viewers who don't know, Superior Plus is a company that operates in the propane industry, distributes propane, supplies chemical and tech products and services, and it has a few other different products and services in its portfolio there. So it's been a pretty volatile stock over the past year. It's got some major swings upward and downward. On the whole, it's last time I checked, it's up about just over 11% on a 12-month basis. So it's kind of trading ups and downs over the past year, but still managed to stay somewhat positive in that time frame, Lindsay.
For sure. Okay. Interesting stuff. Bloomberg Stephanie Hughes joining us live. Stephanie, always great to have you. Thanks so much.
Thank you.
And now joining us for some movers south of the border is Bloomberg senior equities reporter Bailey Lipschultz. Okay, Bailey, we're going to start. It's great to have you join us. We're going to start with Intel. It is set to sell $15 billion in stock after its maybe comeback on the AI boom. Tell us what's happening here.
This is a company that needs to raise money to fund those ambitions. So we've seen kind of a broadening across Wall Street, really, across all of these tech companies powering the AI boom, using different products. So we've seen the likes of Oracle tapping different products, including the convertible debt market. We saw Google use convertibles, regular way equity, and mandatory convertibles. And now we have Intel planning to sell $15 billion of common stock pricing later this evening to fund some of those ambitions. When you look at the management statement, it really is just acknowledging, A, the fact that the stock has more than tripled, depending on the time frame you look at it, over the last few months, and B, they want to use different ways to fund these ambitions. So sell stock when you can, not when you need to. The company was down about 4% on the day, which when I talk to some of these investors or people who play the ECM game, not really that bad. We actually saw it dial back losses to less than 2%. Bloomberg putting out that it's already oversubscribed and have seen some anchor orders stepping in to take up some of those shares. So it'll be interesting how it prices this evening and what trading tomorrow looks like. But it all, again, all things considered, does seem to be another savvy, if not really unexpected move from Intel, jumping on the bandwagon to sell shares to fund some of this spending, as we see in companies and investors really racing to put capital to work to build out things like Foundry for Intel, and for some of those AI companies buying things like chips and building out data centers themselves.
Mm-hmm. Okay, you're also watching Apple today. We've been talking about this after the Jefferies downgrade on reports that Apple is scrapping its all-glass phone. Apple shares falling today. Tell us more.
Yeah, down about 2%, so I'll keep it quick. Just really kind of focusing, at least according to the Jefferies analysts and the team over that does research at Jefferies, really focusing on the sell equivalent rating, on the fact that A, current iPhone iterations are getting more costly, point back towards memory chips and things that are going into the iPhones, actually raising the price, so impacting margins from there. And B, the expectation that the average price for individual iPhones will actually taper off, or if not flatline. Again, back to the point of that all glass phone, looking at the expectations for the foldable phone that'll be unveiled and be rolling out to stores in the not too distant future. The big question comes back to, will U.S. consumers and consumers around the world pay up and pay a premium from what they already are paying for some of those new iPhones? And that's really the bull thesis that Jefferies laid out. The interesting thing to keep in mind is this is a stock, especially among the Mag 7, that's somewhat mixed across Wall Street. The sell side typically recommends buying shares hand over fist. Apple, not the case. And obviously, with the Jefferies underperform rating, outright recommending investors to short the stock.
All right. And just before we let you go, obviously, we're seeing oil surging today because of the conflict, the ongoing conflict in the Middle East. And for that reason, a lot of energy names have been rising today. You've got a couple on your radar. What are they?
Yeah, a couple on my radar, and also just the S&P 500 Energy Index having its best day since the aftermath of tariffs over a year ago. But circling back to some of those names in particular, we saw the likes of Chevron having a pretty strong rally today. Looking across the entire ecosystem, again, that was the best performing of the 11 sectors in the S&P 500. So you've got Valero, Chevron, Phillips 66, as you can see, all rallying. Marathon up more than 7%. So some pretty sharp moves to the green, some pretty solid green arrows. Again, all things considered, it's been volatile. To your point, this is all driven by macro and driven by the ongoing war in Iran. So what tomorrow brings will be another thing that consumers as well as oil traders and oil investors will keep an eye on.
That is for sure. Okay, Bloomberg's Bailey Lipschultz joining us live. Bailey, thanks so much. Appreciate it. Up next, why you should not worry about rising oil prices and AI capex, the bullish case for buying into weakness now. We've got more on that after the break. As oil prices jump today on continuing U.S.-Iran tensions, our next guest says, ignore the negative chatter about returns on AI spending and buy big tech names that are down, but not SpaceX. So joining me now with his bullish outlook is Adam Johnson, founder and author of Bullseye Brief. It's great to have you join us. Thanks so much.
Oh, likewise, Lindsay. And thanks for having someone who comes on who says, yeah, don't worry about the price of oil.
It's nice to hear. We'll get to the tech names in just a moment. I want to start with oil because oil prices, obviously, as we saw, jumping again today. You think $90 a barrel is no big deal. Tell us why.
Well, we've already proven it's no big deal. From 2010 until 2015, oil averaged $85 a barrel. Inflation was just 1.7%. GDP grew at 2.4%, and the S&P 500 rallied over those 5 years 83%. So we've already proven to ourselves that $85 oil is just not a big deal. And given the fact that every day, or sometimes several times a day, the headlines change and oil either goes up or down by several dollars, I think we're all just becoming a nerd to it. We'll get by. Yes, there are going to be some shortages, some dislocations, but it's just not the big deal that I think we keep trying to turn it into. It was at one point, and maybe it could be at some other point, but it just doesn't seem like that's the way it's playing out.
Okay, let's move on to AI CapEx now, because it still seems to be going strong despite growing investor concerns about big spending. Why do you think investors are wrong to worry on this front?
Well, it's worth it. I just, for the benefit of my clients, I put together a chart, fun chart, showing all the massive spending programs of the past, really 100 years. And yes, it's true that the spending by the four hyperscalers this year, $750 billion, is a lot of money, second only to the annual U.S. military budget during World War II. But the fact is, that spending in World War II was worth it. And the spending that enabled the build out of the entire interstate highway system, again, not as much as CapEx spending this year by the four hyperscalers, but that was worth it. The Apollo program that took us to the moon, that was a big number. That was worth it. COVID vaccinations for the entire country, 483 billion. I know it's less than 750 billion, but it was still worth it. My point is, these big spending programs that come along every 10, 15, maybe 20 years are massive numbers that cause people to sort of pause and say, oh my gosh, that's a lot of money. And yes, it's a lot of money. And inevitably, all of these big spending programs are worth it. And what's even better in the case of hyperscaler spending is these companies, Google, Amazon, Microsoft, and Meta, can afford it, which is why they're still putting up 30 to 35% earnings growth. And in fact, given the fact that some of them are actually trading cheaper than the S&P 500, I would argue they're buys.
Okay, so we'll get to some of the stocks you don't like in a moment, because obviously we teased a big one off the top. But just first of all, what are some of the stocks you believe investors should be stocking up on for now?
Well, we just talked about the hyperscalers. Absolutely. I think they're part of any core portfolio. And then there are sort of what I call story stocks. A company like Circle Internet Group, which is the largest issuer of U.S. dollar stablecoin. Lindsay, I'm not sure our viewers necessarily realize, but U.S. dollar stablecoin has become so popular that it trades about 25 to 30% of the volume of Bitcoin every day. You know, we talk about Bitcoin every day. We don't talk about stablecoin. Well, when senators come back from August recess, they're going to vote on the Clarity Act. And if approved, I think stablecoin will go from where it's trading now, call it $65 to, well, the all-time high, which was only about a year ago, was $360. So there's some wonderful story stocks that are just incredibly cheap right now. That's one of them. I look at the volatility in some of the data center type stocks. And by type, I mean Applied Digital, APLD, which builds and operates data centers, to CoreWeave, CRWV, which rents space from Applied Digital and then in turn leases that space out to companies, so that you don't have to necessarily buy your own AI platform. You can just rent the space. It's sort of AI as a service, AAS, AI as a service. So there are all sorts of exciting names like that that aren't, for some people, top of mind, but I really think they should be, because that's where the opportunities are. And when I talk about opportunities, I'm talking about companies where cash flow can double, triple, quadruple over the next 18 to 24 months, and the stocks will absolutely follow suit.
Okay, so a couple big names there. Your bullish outlook, though, does not extend to SpaceX, which is climbing back near its IPO price of about $135. What's keeping you away from this stock?
Price and valuation. SpaceX right now is trading at 100 times revenues. I mean, think of that. You'd have to have an entire century worth of revenue. Forget earnings, because there are no earnings right now. SpaceX is not profitable. You'd need an entire century of revenues just to get to the amount of money that's tied up in the market cap of this company. I think it's too expensive. I'm not buying it right now. There's some IPOs that have come way down. Fervo, which uses the same fracking technology that we know for oil and gas to try to unlock geothermal energy. That's exciting. That's way down from the IPO and from the high. That starts to get interesting. It, too, is still expensive at somewhere around 15 times forward revenues, but 100 times forward revenues with no pathway to profit. Can't buy SpaceX. I just can't justify it at this point. Even though I love Elon Musk, I love Tesla, and I really hope that they don't merge. Yeah, I just can't justify SpaceX right now.
Okay, and just lastly, I want to ask you about Intel. It's down, obviously, after announcing a $15 billion stock offering. Just very quickly, is this a stock that you would buy on the dip as well?
I don't own Intel because I feel like Intel can't really figure out whether it wants to make chips or design chips, but I own a ton of semiconductors from Marvell to NVIDIA to on and on. And so I don't own Intel, but I certainly own all the others.
Okay, Adam Johnson, founder and author of Bullseye Brief. Great to have you join us. Thank you.
Oh, thanks, Lindsay.
Coming up, the Vancouver-based biotech company AbCellera has published its successful trial on an alternative menopause therapy. We'll hear more on that after the break. Stay with us. A Vancouver-based biotech company, AbCellera, published positive phase 2 results for its experimental menopause treatment. The drug significantly reduced the frequency and severity of hot flash symptoms. And we got more from Brendan Smith, senior analyst at TD Securities.
Really high unmet need in this patient population, right? I mean, we're talking about upwards of 12 million women in the US with moderate to severe VMS, only about half of which actually seek treatment. And realistically, there's probably 20 to 30% of those that come in for treatment who can't really get any of the hormonal options available. So what this drug realistically does is it not only addresses some of the unmet need, but it does it even better than some of the non-hormonal options that showed stat sig reduction, like you said, in the the frequency and the severity of VMS symptoms. And probably most importantly here as well is it's not just effective, it's also safe. You know, this is what we've seen time and time again with some of the other non-hormonal options on the market is that there are some liver toxicity issues and there's some monitoring requirements. And this really doesn't seem to have any of those problems. So altogether, it seems like kind of a home run package for AbCellera.
Yeah, because I wanted to ask you about how this compares to other non-hormonal menopause treatments. You kind of addressed that already with that unmet need. You say a lot of women actually can't access some of the treatments that are available right now. What do you mean by that?
So it's a combination of access, but it's also some of the women who come in looking for actual treatment are actually contraindicated for a number of other reasons, right? Some women actually just don't want to take kind of exogenous hormones for, you know, patient personal preference. But some patients are also contraindicated again because sometimes if you're a smoker, if you have higher risk of cardiovascular complications, all of those sometimes will basically suggest to the physician that maybe hormonal replacement therapy isn't necessarily the best first-line option for you. So in that case, there's not too many other options available. There are 2 small molecule inhibitors that have a similar mechanism to AbCellera's drug that have been on the market for a little while. But again, as I've been saying, some of the safety concerns there are really what preclude a lot of women from either taking them or staying on them over a long period of time.
Got it. Okay. And AbCellera now claiming best-in-class efficacy for this drug. Is that fair to say, or do you think it's still too early to tell at this point?
I mean, look, it's phase 2 data. We obviously want to see how a full registrational study with the sign-off of the FDA looks and how that data also compares to this phase 2. But when you really compare apples to apples from phase 2 of this drug versus the other competitors with a similar mechanism in the space, it showed stat sig reduction in the frequency and severity of those VMS symptoms. And it actually was numerically deeper reduction out to 4 weeks than some of the other drugs on the market. So when you're trying to compare apples to apples, I think it is actually a fair statement with some important caveats just until we see the full phase 3 data.
We know women's health often lags behind when it comes to studies, when it comes to research, maybe funding as well. Could success in this drug lead to increased investment and therefore ongoing innovation in women's health, do you think?
We would hope so, right? You know, I think historically, like you said, I think you really hit the nail on the head here. This is an area that's historically very underfunded, under-researched, and understood, right? There's a lot of outstanding questions that are kind of underpinning some of the biological rationale for not just the drugs, but frankly, the actual conditions themselves too. So one would hope that this not only helps the women who are coming in for treatment, but maybe helps kind of remove some of the stigma for some who are maybe considering coming in, but don't want to, or who are unsure about some of the options available to them. So helping kind of bring some more patients into the clinic to actually get available treatment. And then, like you said, hopefully help some folks within the operating part of the industry continue to look at some of the other opportunities to fund more of this research and develop more of these kinds of drugs.
Mm-hmm. Obviously, still many steps to go before this drug can come to market. What are some of the biggest hurdles that you foresee for AbCellera when it comes to getting this drug to market?
Yeah, look, again, this is just basically 4-week data from the phase 2 study. So what they have also committed to as of this morning when they release the data is they'll have 12-week follow-up data later this year, which is always going to be important to watch. This is a single dose that they give to patients in this phase 2 study. So, of course, this is a single dose of, a subcutaneous shot, right? So it's also worth mentioning that relative to the other drugs that are on the market, which are daily orals, this is basically a once monthly shot, not unlike some of the GLP-1s that we see out on the market there. So I think first we want to see what multiple doses do in a larger registrational study. We want to follow patients for a little bit longer, right, to make sure that there's none of these off-target effects that emerge with longer exposure to the drug. And then, of course, we would like to see this kind of great efficacy, best-in-class potential safety, as well as reduction in the severity and frequency of these symptoms replicated in a larger scale study.
Okay, and just before we wrap up here, I wanted to ask more about the biotech sector in general, because AbCellera is hoping to strengthen Canada's presence in the biotech sector. If this drug succeeds, what impact do you think it could have when it comes to Canada's standing in the sector?
Yeah, it's a great question, actually, and I'm frankly a little surprised that I haven't had more questions about that in particular this morning after the data has come out. Look, I think it's no stranger, it's no surprise either that there's a lot of interest in this sector, particularly this year. I think we've seen a good amount of capital start to flow across, whether that's through follow-on offerings, starting to see some more IPOs come across the deck as well. So I do think it's reinvigorating and I would say continuing the momentum that we've seen year to date in biotech. I think there's always going to be more to come and always more work to do.
That was Brendan Smith, Senior Analyst at TD Securities. Up next, a $100 million rebate program for Canada's steel industry. We've got more on the headwinds and the opportunities for this sector after the break. NVIDIA is partnering with Wall Street on a funding package. The chip giant is teaming up with U.S. investment firms like Apollo Global, BlackRock, and Brookfield Asset Management to invest $500 billion into AI infrastructure. NVIDIA says the coalition will help customers access scarce compute at scale and build the AI factories needed to power every industry. Oil prices rose today after U.S. President Donald Trump says he's prepared to let economic pressure take its toll on Iran instead of launching further strikes. Iran says the Strait of Hormuz will only reopen if Washington agrees to several conditions. That includes lifting its naval blockade and sanctions, withdrawing American troops from the Gulf region, and releasing frozen Iranian assets. And shares of Vancouver-based AbCellera saw a surge today after the company's mid-stage trial of its menopause treatment succeeded. The drug significantly reduced the frequency and severity of hot flashes. The non-hormonal antibody therapy is still in the mid-stages of trials. And shares of Berkshire Hathaway ended the day higher today after the conglomerate posted better than expected second quarter results. The quarter was driven by gains in its manufacturing, service, and retailing division, which helped to lift operating income. Berkshire's energy segment also surged 27%. The company also spent roughly $4.5 billion to buy back shares.
Lower transportation costs will strengthen the competitiveness of Canadian steel in an evolving global economy. And they will support workers, like the ones here in Hamilton and across Canada, who produce some of the highest quality steel in the world.
And that was Transport Minister Stephen McKinnon announcing a $100 million rebate program for eligible Canadian steel products moved between provinces and territories. And for more on this and the challenges for Canada's steel sector amid ongoing CUSMA trade negotiations, let's bring in Marvin Ryder, Associate Professor at the DeGroote School of Business at McMaster University. It's great to have you join us. Thank you.
Glad to be here.
So $100 million in rebates for freight costs of steelmakers. How significant is this announcement really?
Well, first, I should note that it was rumored last fall that it was going to happen in the spring of this year. So the steel industry has kind of been waiting for this announcement for the better part of 3 or 4 months. It's significant in the sense that we're trying to get the steel industry to pivot. If it's losing markets in the United States, can it do better domestically? One of the concerns domestically is competing against foreign steel. How do you keep the prices reasonable? Well, in this case, it's by subsidizing the transportation cost of a fairly heavy commodity. Transportation is not an insignificant cost. And so they're trying this. The 100 million figure is sort of just plucked out of thin air. They're going to try it for a year. If the money runs out, I won't be surprised if they top up the fund. If it turns out there's still money at the end of the year, I expect they'll extend it. They're just trying to give the industry some help as it struggles going forward.
Yeah, I think they did say that they would extend it if it hasn't run out by the end of the year. But just curious, like how competitive is Canadian steel at this moment? And then like you touched on it, but how much will this rebate actually help?
Yeah, that's a great question. So here in Hamilton, we have two major steel companies, Dofasco and Stelco. Neither of them have laid off employees, and both of them have shown relatively healthy profits. Now, there's nothing so good that it couldn't be better, and they would argue that if those tariffs weren't in place from Mr. Trump, they would be able to do even better in the marketplace. But so far, the pivot to Canadian markets has worked very well. This is just another support for that. That's why the program is just a one-year program, not a 5 or 10-year subsidy.
Mm-hmm. Because while promoting interprovincial trade, Carney has also been trying to encourage Canadian companies to find markets outside of the U.S. I wonder, can Canadian steel find such markets? And if so, where?
So it is finding markets in other places, in particular parts of Europe are interested in Canadian steel. What's interesting is you can't subsidize the delivery cost to those international markets. Otherwise, in international markets, Canada would be accused of, quote unquote, dumping the steel. So this is something Mr. Carney and his government can do within Canada, because we don't have an allegation of dumping between Alberta and Ontario or between Halifax and Manitoba. But it's not something he could do internationally. So again, found a little program, throwing some help into the marketplace, and seeing if it can make any difference going forward.
Interesting. And really, at this point, like just how much have the U.S. tariffs impacted Canada's steel sector? And could CUSMA talks make it maybe worse in any way?
Yeah, well, I wish I had a clear answer for you here. So in Hamilton, we have a steel company called Stelco that is owned by an American company called Cleveland Cliffs. The CEO of Cleveland Cliffs is actually encouraging Mr. Trump to keep those tariffs on. He likes those tariffs in the United States. And you think, wait a minute, isn't it affecting your operations here in Canada? So he seems to be talking out of the wrong side of his mouth, so to speak. Dofasco also is an international company. Its head offices are in Europe, and it seems to have done the pivot very well. So I wouldn't say they are struggling. But again, remember, nothing so good that it couldn't be better. They're looking for those supports so they can keep making sure that they're going to survive. Why? Because Mr. Trump is, of course, so hard to figure out what he's doing. He'll say one thing one day, another thing the next. And August 19th, his deadline around some future tariffs is looming. So I think this is why the government's getting out ahead of that with this program.
Yes, August 19th, the next deadline day that we're watching for. In the meantime, though, like what do you see as the main challenges and opportunities for Canada's steel industry at this time?
Well, again, I hate to say it to you like this, but it's all linked back to Mr. Trump. Ever since he's become president, he makes these announcements, not studied, not deeply researched, but he'll say one thing on a Monday and another thing on a Wednesday, another thing by Friday. And that's introduced a lot of uncertainty in the market. And so steel is something you don't buy on a drop of a hat. It's something you plan to use over a longer period of time. and he's caused uncertainty, not just in Canada, but around the world. And that's the biggest headwind facing this industry, is this uncertainty. If we could get back to something more predictable, it would be better. The good news is, in the face of what Mr. Trump has been doing, Canada has been prepared to put money into something called infrastructure, building bridges, building airports, redoing roads, building new schools, all of which need steel. So we have opportunities domestically, and I think that's why the industry is not taking as big a hit as it might otherwise. But there is a limit to how much I think government is prepared to spend on that infrastructure.
Of course. And just lastly, as you mentioned off the top, like there was hints that maybe this was coming months ago. The government also hinting that maybe there's something on the way for the forestry sector. Like, I wonder, can we expect to see more announcements for different sectors in Canada moving forward? Is there anything you've heard?
Yeah, so my answer to that is yes. If, for instance, I'm not in the steel industry, let's suppose I was in the aluminum industry, or I'm in the forestry industry, well, thanks for helping our buddies over there in the steel industry, but what about us? We've been affected by all of this too. So I am not going to be shocked if the industry minister mentions similar kinds of programs for other sectors out there. Now, just how many, I don't know. I don't necessarily think, for instance, it would go to the liquor industry, but I won't be shocked to see further government supports to try to calm the market in the face of all this bubbling uncertainty south of the border.
Okay, Marvin Ryder, Associate Professor at the DeGroote School of Business at McMaster University. Really great to get your insights. Thanks for joining us.
Glad to be with you.
Up next, we are watching shares of Meta rise today after CEO Mark Zuckerberg said the company would open source its most powerful AI models. More on that in a moment. Stay with us. Shares of Meta rose today after the tech giant CEO, Mark Zuckerberg, said the company would open source its most powerful AI models, meaning they can be downloaded and used by the public. Zuckerberg also said the company will release a new family of open source models called Muse Glimmer, designed to run on laptops. So let's get more now from Kyle Chan, research fellow at the Brookings Institute. It's great to have you join us. Thanks so much.
Great to be here.
Okay, so Zuckerberg, it seems as though making a major push to position Meta as a stronger competitor in the AI kind of field. I wonder if you agree with that. Like, how does open sourcing AI models really help to achieve that for Meta?
Yeah, so it's funny. It's like a return back to Meta's original playbook. You know, Meta was really the pioneer for open source AI models for the entire world, long before the rise of DeepSeek and the Chinese open source competitors. Meta's Llama family of open source models were loved the world over, including among developers in China. It was a powerful platform that allowed Meta to also reach a lot more users and developers. And then recall that they had switched, perhaps under greater commercial pressure, feeling like they were slipping behind the frontier, competitors like OpenAI and Anthropic gaining speed and pulling ahead. So they switched to close models. And for a while, they built up this super intelligence team. And now it seems like they're ready to flip back in the opposite direction. And I don't think the timing is a coincidence that this is happening when there's this bigger open source debate going on in the United States, and especially about what to do with Chinese open source models.
Yes, we're going to get to that in just a moment. But I wanted to ask, first of all, about Meta's AI spending. It's spending as much as $145 billion on AI CapEx this year. Obviously, that's been drawing a lot of scrutiny for investors. Do you see this open source strategy as kind of like a Hail Mary by Meta to justify the massive AI spending that it's been doing, that it's planning on?
Yeah, in some ways, this is a bet on a different kind of strategy than what we're seeing perhaps with the more now traditional AI companies like OpenAI and Anthropic, or even like Google DeepMind. So Meta doesn't sell cloud services. It's not a major cloud platform like Amazon or Google. So AI is not something that will power their cloud business. They're also not such a big seller of models directly either. That's the OpenAI or Anthropic model. So instead, what it looks like they're trying to do is they're trying to boost adoption of their models more broadly and hopefully technology that will help turbocharge some of their existing other properties like their social media platforms and other AI-powered devices and services, maybe some of their Meta Smart Ray-Ban sunglasses, for example.
Yes. Okay, so let's start to bring China into this conversation a little bit more, because Mark Zuckerberg says that the U.S. shouldn't restrict access to foreign open weight models, particularly Chinese ones. What does he mean by that, and do you agree with that statement?
Yeah, I think ultimately he's talking about Chinese open source models. And I think that the US AI industry is split right now because there are some, like especially Anthropic and OpenAI, who have advocated more strongly for closed models and have warned about, especially Anthropic, the AI risks and safety concerns that have to do with open source models. But on the other hand, a lot of other AI players in the United States are building on and really adopting open source as a strategy. So what's interesting is that if Meta starts to, let's say if they supported a block or ban on Chinese open source models on the grounds that they're open source, that could come back to bite them. So they have to kind of walk this fine line where, in a way, they're almost aligning with the broader open source movement, which includes the Chinese open source model. So it's a much messier picture than simply the US versus China or closed versus open.
For sure. Zuckerberg also saying American AI developers, though, face too many restrictions. What is he referring to really there?
I think this is a not so veiled jab at Anthropic. I think Anthropic, as the perceived industry leader in many ways, is getting a lot of scrutiny for its particular approach to AI safety and guardrails. Recall that the Fable model, which was a version of the really powerful Mythos model from Anthropic, was released with really, really strong guardrails, for some too strong, to the point where it degraded the ability of users to ask it questions about, say, AI development itself. You could see from Anthropic's point of view, maybe they were worried about other labs using Claude, using their models to build more powerful models for safety reasons. Maybe they're worried about competition. Whatever the reason is, though, that's something that really rubbed a lot of developers the wrong way. And now Meta is trying to position itself and Mark Zuckerberg as being on the, quote unquote, right side of AI history.
Right. And because Meta doesn't currently have AI models as powerful as those from Anthropic, for example, or OpenAI, does its open source strategy pose less of a national security risk to the U.S.?
One can argue that to a certain extent, that the risks do go up with the capabilities. And so if you're not at the absolute frontier, there is somewhat less risk, although I would say that it's all on a spectrum. And so right now, I think the way that Meta is trying to frame their position is, look, these issues are best dealt with through powerful, widespread models without all the extra overly conservative guardrails. This would be their messaging that Anthropic has tried to position, and also that it shouldn't be a monopoly or oligopoly of just a handful of AI companies controlling access to AI for everyone.
Okay, we've got to leave it there. Kyle Chan, research fellow at the Brookings Institute. Really great to have you join us. Thank you.
Thank you.
Lundin Gold is in focus after reporting second quarter results last week, and we'll get the CEO's take on the quarter and what's next for the company. Stay with us. Lundin Gold's second quarter results came in slightly below consensus estimates on profit and revenue. However, the gold miner elected to maintain its full year production target. We got more from Jamie Beck, CEO and president of Lundin Gold.
We have a significant income tax and profit sharing payment that actually impacts Q2. So this quarter we paid $221 million in profit sharing and income tax, and that always impacts our free cash flow metrics. It tends to be a little bit rocky, where Q1, 3, and 4 are a little bit higher than analyst predictions, and then Q2 ends up being a little bit lower. So these results were very much in line with expectations, given the strong gold prices, and we were thrilled.
All right, and you're still on track for 475,000 to 525,000 ounces of gold this year. How confident are you reaching in that upper bound, and what needs to happen to get there?
We had always anticipated that the first half of the year would be a little bit weaker. We were into a portion of the mine plan where we were anticipating some lower grades, and we had a few maintenance items that were going to impact Q2. And so we actually anticipate next quarter to be one of our stronger ones. So we're quite confident that we'll be right in the guidance range.
Right, and your AISC guidance remains at $11.10 to $11.70 an ounce. How are you thinking about cost pressures and margins in the current gold price environment?
We're very fortunate at Fruta del Norte. It's a high-grade underground mine, and we tend to have a really good control on our cost profile. One of the biggest impacts to our costs actually is the gold price. So for every $100 increase in the price of gold, we actually pay about $10 additional in taxes and profit sharing and royalties. So that's the biggest swing factor. If gold prices continue to be strong or go up, then our costs will rise a little bit. But I'll take that extra margin.
You've also said that you're going to begin purchases under the normal course issuer bid in the near term. What makes this the right time to buy back shares, and how do you balance buybacks with investment in the business?
Yeah, one of the unique things I think that we've got at Fruta del Norte and at Lundin Gold is a very robust capital returns policy. We pay a fixed dividend, which is 30 cents. That works out to about $300 million a year. We pay a variable dividend on top of that, which is set at a minimum of 50% of our free cash flow. Over the past 3 or 4 quarters, we've actually been paying 100% of our free cash flow. And this past quarter, we did a dividend in kind of a silver stream company that purchased something from us. So we're one of the highest dividend yielding stocks in the gold mining space, well over 7% on our last quarter, which is quite unique. And we're not changing that. We're going to stick with our capital return policy as it relates to the dividends, but we do have a robust cash balance, and so we'll be using some of the cash on hand in treasury to opportunistically buy back shares. We've had that buyback provision in place since February. We renewed it. So this is just really a reminder that if we start seeing that the value in our underlying shares isn't being reflected in the market, then we'll look opportunistically to use our cash balance to do some repurchasing.
And you talked about the growth potential at Fruta del Norte, and miners are constantly trying to find ways to expand and grow. So how important is this to those future growth and expansion plans, and where do you see the current mine's production profile beyond the current plan?
Yeah, it's absolutely critical. You know, we've got what looks to be, based on our reserve and resource statement, sort of a 12-year mine life ahead of us at Fruta del Norte. But our exploration success has been tremendous, and what we're targeting is being able to maintain this type of production profile for the next 20 years and beyond. And so that's just on the gold and silver side. We've made new epithermal gold-silver discoveries to the south, to the east. We've had encouraging hits more broadly along our land package. So exploration really drives the continuity of our business and being able to maintain that production profile and those cash flows. And then what's really been a game changer for us more recently has been some very, very large near existing infrastructure copper gold discoveries. These are a different style of mineralization, but as we're learning more about them, as we're drilling them off, and as we look towards the future, you know, within the next certainly 3, 5, 10 years, this company will ultimately also be a very significant copper producer.
And gold prices remain very strong. How are you thinking about capital allocation if that environment persists?
Yeah, it really, doesn't change too much for us. I think I point to our cost profile. We were able to get it out of the ground at 1,150. When this quarter was 1,176 per ounce. So even gold can move a little bit up and down, and we maintain those strong margins, and that the flexibility that we've built into our dividend policy is really tied to our profitability and free cash flow. So I'm not concerned that the fixed dividend's at risk, and we'll just continue to return capital to shareholders in a very sort of prudent and proactive way.
That was Jamie Beck, CEO and president of Lundin Gold. That does it for today's program. Thanks for joining us today.